Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
Are markets getting less efficient? And if so, why are they hard to beat?
Yeah, so I generally operate under the assumption that markets are getting more efficient almost all of the time, and that in particular, if you have any measure of market efficiency, then it's going to make it look like things are harder to beat all the time, because there is just this general process where when investors start looking at some new asset class, or when a given country's markets are really immature, everything is just weirdly mispriced. I'm actually reading through an incredibly detailed book that it goes through what was going on in the stock market through every year of the early 1930s, broken down by industry, and for every industry, it just lists, here are the main companies, here's what their PE ratio was, their price to book, their return on equity. And you just see weird stuff. Like, there were a lot of industries that traded at a premium, but didn't get especially impressive returns on equity, like sub 10%. And then the food industry was full of companies that were earning like 20 and 30% returns on equity, even during the Depression, and just didn't trade at much of a premium. So like, markets start out pretty inefficient, and you look at a book like that and just feel like you were born in the wrong generation. You should have just invented the concept of private equity in 1931 or something and made a killing. But anyway, like, the market has gotten more efficient in that respect because we have more data and we have just a better sense of how to evaluate companies. On the other hand, there are some statistical measures by which it looks like the market is getting less efficient, and there was a recent paper by Cliff Asness, who is a really sharp guy, talking about this claim, making the claim that markets are getting less efficient. And his key metric for this was looking at the ratio of valuation metrics for the most expensive stocks versus the least expensive. And he pointed out that it's actually more extreme than it was at the peak of the market in the dot-com bubble, which was the last great growth boom. So in comparison to dot-com 1.0, we actually have more stretched valuations, but And also, you can come up with a bunch of stories on why that's not such a big deal. Maybe there's a weird interest rates thing. Maybe you have to account for intangibles. But when you actually try to quantify those, you still don't actually get to very good answers. Like, you don't get to an explanation of why big growth companies are cheap. They look less expensive on those metrics, but not by a huge margin. And I think that one way to square that circle is that a lot of these companies are in fact very well run. And in particular, one of the things that they are willing to do that makes them better quality companies, but actually makes them screen worse on the metric that's labeled quality, is they will dump a lot of money into some project or accept a lot of opportunity cost for some strategic move where they know it's necessary for their business, they know it'll actually help their business long term, or they believe that it has a good shot at it, but in the short term, it just costs money. And if you look at how quality is defined for systematic investors, they're looking at things like how stable are this company's profits, how high are their margins. And so one way to make a company screen worse on quality is, if that company is Google, start something called Waymo and spend billions of dollars on self-driving cars. For a long time, they don't make any money, and they just cause lots of PR headaches, and they distract a bunch of your best software engineers and machine learning experts who are trying to figure out how to differentiate between a plastic bag and a cat crossing the street, instead of trying to figure out how to make ad targeting 1 basis point more efficient. So if you do that, your quality score, like you're on a quality metric basis, you look worse. But what you end up with is suddenly you have a self-driving car business that actually seems to have pretty good unit economics and is starting to expand quite rapidly. Similarly with Meta, it was probably very bad for their quality rankings that they did things like put unmonetized reels very prominent in the Instagram and Facebook apps. That was taking up a lot of ad space and taking up a lot of revenue. And it eventually switched from being a headwind that they called out every quarter as, yes, we know this is expensive and we're still doing it, and turned into a tailwind that they don't really disclose the exact details of, but it seems to be going well. For the metaverse, we will see. I think the metaverse is not really a place that I want to be. I think the actual real world is pretty good. But I also recognize that it's a really bad idea to bet against Mark Zuckerberg. And it's a particularly bad idea to bet against Mark Zuckerberg in a case where he feels like he made a big mistake by not being slightly earlier to mobile. And Meta, then Facebook, was really early to mobile. If you go back, my go-to example of this is it used to be that if you went to their investor relations page and looked at their press releases and just scrolled back to the very beginning, the first press release was the 2006 announcement of, I believe, their Series B round. And it's a very terse announcement, but they do mention that one of the things that they want to spend the millions of dollars that they raised for a social networking site at a time when that was an absurd idea, they wanted to spend that on mobile. And this is half a year before the iPhone comes out. So they've been aware of they were aware of mobile for a long time. They realized that's where people were going. They didn't move quite fast enough. They weren't quite aggressive enough. But now they're a big enough and profitable enough company that they could be very aggressive indeed in moving to what they believe the next interface and next interaction format will be. So I think if you consider the return that they end up getting on those kinds of investments, and I think this applies to basically all of big tech, that they're all willing to subsidize businesses that lose money for a long time, but that they recognize the unit economics will probably eventually pan out, and there may be some strategic reason they want to do this, that does make them look more expensive than they really are. And then it does tend to work out. And like right now, if you look at the biggest big tech company that has a serious bear case, it's Google. And the bear case is they're just too good. Like they are so good at strategic acquisitions and so good at running a search engine and so good at boxing people in on the rest of their ad business that they basically have to get broken up or have to get some kind of serious antitrust remedy. So that when you look at aggregate valuation metrics and say things are stretched, that may be true. Like things may be stretched by historical standards, but then you do have to go from that to saying, okay, like here are the specific companies I think are overvalued. And you can do that. Like there is this category of companies that I do think, like I can't really understand why they're priced the way they are. And they are high quality, large growth companies. So Costco might be a classic example. Like it's a really good company. It's a really good product. They are not going anywhere. They will, I would be willing to bet that they will be a much larger company and will have gained market share in US retail spending over the next 20 or 30 years. There are very few companies where you could say that about them, but also I don't know that investors will actually make any money on that because it trades at an extremely high PE ratio and the growth is still like above GDP. It's still above growth in retail spending, but it's, in my view, not high enough to justify that. So like there are these areas where things do seem misvalued from my perspective, but I'm also not super excited to short Costco because if the whole thesis is I can't really justify this valuation given that it's growing slowly, but also I love the company. Well, you could have said that at a PE of 30, and you will probably still be saying that at a PE of 80. So the fact that it's overvalued doesn't lead to a direct thesis for shorting it. Now, when Asmus is exploring, okay, why could this be given that, hey, we have all this additional information, there are so many people who spend all of their time trying to figure out mispricings in stocks, he does come up with two hypotheses, one of which is retail investors are just lunatics sometimes and will drive up valuations to crazy levels. Obviously, GameStop comes to mind. You can also view Tesla as like a weirdly cultish stock. There are a handful of other like larger companies where they have a large retail base. Those retail investors are very enthusiastic about the company, not incredibly price sensitive. When they mention PE ratios, it's often coming up with kind of like interesting projections on what earnings will look like in the next couple of years and then backing into here's why it's still cheap. So like maybe that explains some parts of misvaluation. And then the index part is also, it's tricky because at one level, indexing is saying, I'm not going to pay attention to the valuations. I'm just going to buy this portfolio, diversified portfolio, 500 biggest companies in the US roughly, and I'm going to hold it. And I know that I'm actually probably going to outperform the median professional money manager over the tenure of my money management career, which like your money management career in that scenario could literally be about a minute and a half of setting up an account, setting up automatic deposits, and then you don't think about it again until you turn 65. So that could lead to stretch valuations, but there's another party to this, and you have to consider their incentives, and you have to ask yourself what behaviors you'd expect if stocks were systematically overvalued. And that party is the CFOs, CEOs, chair people, like people at these companies who, if the company's stock is really overpriced, they should be selling shares. They should be issuing as much stock as they can. And what they should absolutely not be doing is borrowing money in order to buy back that stock. But we actually, in the same week that this paper came out, there was also a record-breaking day in terms of number of new investment-grade bonds issued. And most of the companies issuing investment-grade bonds are spending most of their cash flow on buying back stock or returning it to shareholders in other ways. So it's at that point, like you can still tell the overvaluation story, but you also have to add into this story that the people who are most bullish and most irrationally bullish are the people running these companies. And again, like it might be true, but it becomes a more and more stretched story over time. And I think a better story to tell is that the market used to be incredibly inefficient with respect to a lot of signals that you could find just by getting lots of historical data and running some regressions. And a lot of money was made doing that. And the people who made it deserved every penny of it, because there were just cases where the average market participant was not thinking broadly enough. They weren't being rigorous enough, and they didn't know what they were doing. But now that systematic investing is a huge asset class, and a lot of the things that were like a secret source of alpha are now widely published beta, and you can pay 10 basis points a year to get access to that beta if you want to. So that part has gotten more competitive. And if you have a case where, this goes back to the getting more efficient thing, if there's a measurable way that you can describe the market as inefficient, that's also, it is implicitly a trading thesis for making the market more efficient and making yourself money. If you make that trade, you've made the market more efficient in the ways you can measure. And either that means the market gets perfectly efficient or it gets inefficient along the axes that you can't measure. And I think we're more in that world of, there are hard to measure things, but there are like a lot of the less quantity, more discretionary investment managers are actually thinking about those variables. They are asking themselves questions about NVIDIA's strategy and, how is Microsoft going to benefit from big corporations using AI? Will these corporations want to use a new startup that no one has ever heard of because it was founded 3 months ago, or will they want to use Microsoft and work with the same people they've been working with for decades? I think the bet in that case is, yeah, Microsoft gets that incremental AI dollar from corporate America, and that doesn't show up in their financials right away, except in the qualitative commentary they give on earnings calls, where they talk about AI deployment, they talk about how much of their cloud computing growth is due to AI. And that the people who are extrapolating that, like, they will probably get a lot of the details wrong, but also they are making this reasonable bet that the revenue that Microsoft gets does deserve a higher multiple than it used to, and they can absolutely justify that.
Yeah, that's a helpful overview. I want to zoom out and ask you to comment briefly on the efficient market hypothesis in general. It's this sort of funny rift that economists and sort of investors have, where a lot of economists believe it's true. And of course, investors don't. I remember Ray Dalio was on Tyler Cowen's podcast, and Tyler was sort of asking him a question of, how do you know this is true? And Ray was like, well, I have 50 years of investment data to prove it. And Tyler's like, that's not good enough. Like, you have to have a theory or understanding. You can't just say, that. And it was just a funny sort of example of that sort of philosophical, I guess, difference or something.
I think some of it is a communications issue in a couple of ways. One of which is, apparently a lot of the people who say markets are efficient, they mean like markets are roughly efficient, or they mean markets are efficient in the sense of, you probably can't beat the market if you are an amateur investor who occasionally reads the Wall Street Journal and, just randomly buys low PE ratio stocks, or buys companies that you read like the product. Like, that might actually get you some excess return, but it's probably not going to be worth the effort. And so there's like the ultra strong market efficiency. The ultra strong version of this would be, even if you had perfect information, like even if you got the earnings release the next day or the day before it came out, you would never be able to get excess returns. And I don't think anyone seriously believes that. And then the weaker version of that is, markets are going to roughly incorporate most of the information that's publicly available. They'll do that in a fairly timely manner. Someone probably does get some excess return, but that return is closer to the income you get from your job, and your job is make the market more efficient by accurately responding to new information. So like, there is, in that scenario, there's like beating the market, but it's kind of like you earn an accounting profit, but not an economic profit, because if you are smart enough to always incorporate that new information into market prices, you are also probably smart enough to be, a really good marketing person or product person or software engineer or something. You'd probably be making similar amounts of money in some other field. You just happen to be in that field. But there's also, so some of it is like, yeah, there aren't very many people who literally believe that all prices are 100% accurate reflections of all human knowledge. And then the people who believe that the market is roughly efficient don't actually think no one can beat the market. They just think it's statistically unlikely, that it is probably more likely that someone who has a really good track record got lucky than that they were truly good. And, you can definitely debate that. And I do think that there is such a thing as investing skill. I think that there are replicable strategy, like there are repeatable processes that can lead to excess returns. And then there are non-repeatable skills that people have, where they're just able to suss out the right details, ask the right questions, and make some pretty good stock picks that make them some good money. But also, one of the reasons that academic finance talks about the efficient market hypothesis is that it's just an easier working hypothesis that allows you to model other things and allows you to talk about other things without just constantly getting back to this question of, okay, but what if one stock is actually trading at twice the value it should be? Like, that is like a legitimate question if you're putting this into practice. But if you're trying to develop some kind of general model of, I don't know, how changes, like how the growth of equity markets affects economic growth and affects which industries get more investment or less, or if you're trying to figure out, okay, what is the fair value of an option or a warrant or convertible bond, it just adds a lot of extraneous detail if you say that we're not going to assume that prices are perfectly efficient. Whereas if you say, okay, we're going to assume for the moment that prices are perfectly efficient. We're going to assume that Coca-Cola trades at $50 a share. It's worth $50 a share. Okay, given that, and given the volatility of Coca-Cola stock, what is it worth to have the right to buy 100 shares of Coca-Cola a year from now at $55? So yeah, I think it's easy for people to beat up on each other over the efficient market stuff by not taking the other side's, I think, not taking the other side seriously at the level at which they're trying to operate. So, and also, there is the paradox of market efficiency where if the market is perfectly efficient, it doesn't pay to make, like, it doesn't pay to make any investing decisions at all. So everyone should put their money in index funds, at which point the market is no longer efficient because nobody's keeping it efficient. So, like, in practical terms, you do have to assume that there are always inefficiencies somewhere. But if you're trying to develop some useful theory, you start with the assumption of markets are pretty efficient, and then you work from there. And it turns out that those theories, like the pricing theories for which EMH is a load-bearing assumption, are actually pretty useful theories. And it is probably better for the financial sector as a whole that there weren't just a lot of arguments in Finance 301 about market efficiency, and the professor just put his foot down, said, we're going to assume markets are efficient, and we're going to go from there.
Yeah, that makes sense as an explanation of how they reinforce each other or work well together. Let's talk about, we mentioned big tech earlier. You wrote a piece about how big tech, you have an analogy of big tech as a fleet rather than an aircraft carrier, and what happens when they get so big that spinoffs may or may not make sense.
Yeah, so this is something I've thought about a lot because Amazon seems to have been just designed from the beginning to be be like a collection of Legos, and you can snap off a Lego and incorporate it into something else and it works just fine. And they seem to have done that in part just as this sort of broad strategic mandate of if you aren't treating every part of the company as if it were an independent company, you will allow weird costs and inefficiencies to creep into your system. You won't be able to audit them well because your retail person will say shipping is too expensive because the logistics people are doing something wrong. And then the logistics people will say, no, shipping is too expensive because retail is insisting on implicitly subsidizing the most expensive trips. It's just a whole lot easier if Amazon Logistics says, okay, Amazon Retail, here's how much it costs to deliver this package, take it or leave it. And it also does mean that they can turn, and this is the classic Amazon bull thesis, they turn every line item on their costs into a revenue item, and then that allows them to have a lot of different growth opportunities. And if they don't know where the value is ultimately added and captured in e-commerce and in the broader spectrum of everything that Amazon does, if you don't know where the value actually accrues, then you do want to be pretty agnostic early on. And then you want to figure out, okay, is e-commerce on its own a really good business? Is it a good business if you bundle a bunch of other services together and use it to cross-sell things? Is it a good business because running ads based on searches people have done for particular products is an incredibly lucrative way to basically tell every third-party seller on your platform, why don't you just tell us how much money you would make if you got this sale and give that money to us and you'll get the sale. If you don't really know, you want to have that kind of decentralized approach. On the other hand, and so that's what pushes all of these companies to decentralize, and Amazon just takes it more seriously than most. The thing that pushes them to centralize is, okay, but these things are actually pretty deeply related. So there is this case to be made that if you build a new fulfillment center, maybe the reason it makes sense on the margin is that it causes more people to sign up for Amazon Prime. Those people end up watching more videos. Those videos have lots of ads for things that are not sold on Amazon. And Amazon actually ends up turning this warehouse investment into a stream of high margin ad revenue somewhere else. Now, that does require some internal coordination. You can imagine the ad business paying the retail business to pay the logistics business to slightly change their factory footprint or their distribution center footprint, but maybe it is easier to just manage some things like that pretty centrally. And then if you look at someone like Google, they are just a lot harder to break up. Like, they clearly have a lot of businesses that are very valuable on their own. If Chrome were spun off, it would be one of the most valuable software companies out there. Not in like the top 5 list, but it would be like a substantial company, because Chrome's implicit business is they are reducing Google's cost of Google's traffic acquisition cost. And if you look at how much Google has, like what kind of revenue split Google has to give Apple in order to get that search exclusivity, you could imagine something similar for an independent Chrome. And so you could actually imagine Chrome being like a company that does tens of billions of dollars in revenue and doesn't really have to spend that much money. Like they have to update their browser. I'm sure they have lots of people working on it. I'm sure those people are very expensive, but the margins for a standalone Chrome business would be just pretty crazy. But one of the reasons that Chrome makes a lot of sense as part of this broader company is that Chrome is just a really good source of data. So one of the ways that Chrome adds value for Google is, let's say I search Google for the name of a book, and then I don't click on anything. And then I go to Amazon.com and I search for the name of the book or the author or something else. And then I find it and then I click purchase. All of those clicks, Google, like Chrome sees all of those clicks. So Google finds out that they don't have very good search results for this particular kind of search. That's very useful feedback. They also see a lot of other interactions people have with different sites. It's really good for security stuff. It's really good for just having a better view on user behavior. So Chrome is like, it would be very valuable as a standalone company, at least until Google built its own Chrome replacement and we just kind of reran the Firefox story over again. But it also is a lot more valuable as part of Google. And I suspect that a lot of Google's businesses are like that. Like it has to be very valuable to Google for YouTube to be under the same umbrella as a search company, because YouTube is also a search business. Like people like to talk about how in a lot of countries, number one search engine is Google. Like in some countries, it's like number one search engine is Google dot that country's TLD. Number two search engine is YouTube.com. Number three search engine is YouTube or is Google.com. And since YouTube is partly a search product, it really helps to have more search data. It helps to have better search algorithms. And that also works in the other direction, where if someone is searching for something and Google knows that what they're looking for has some video results, Google can steer some of that traffic to YouTube. It can display the YouTube videos more prominently than other search results or than other video search results. So there are a lot of synergies there. And again, YouTube would be a very valuable consumer brand on its own. It would be, right up there with Chrome as one of the most valuable internet properties out there, but it's even more valuable as part of Google. Microsoft is also it's really hard to spin off, because with Microsoft, you could imagine a split of, there's like an office software and operating system business. There's a games business. There's the cloud computing business. But aside from games, which I guess they could split off, but I think they feel like they sort of won the Office desktop and then gave up a little bit of that because Apple made some inroads there. But they never, gaming is a way for them to win, or at least have a foothold in the living room rather than the office, and to have more channels to sell things directly to consumers. So it could be spun off, but it almost feels like with gaming, that is the kind of business where you could see a company subsidizing that just so that they don't lose their access to the consumer. And that would mean that the business on a standalone basis is just not quite as profitable, as it's not as valuable to public market investors as it would be to Microsoft. And then you've got Meta, where they also, a lot of their products do make a lot of sense as a standalone, but there are some nice crossover things. And actually the crossover aspect of Meta, it was probably illustrated best by Threads, where Threads allowed them, they saw an opportunity to bootstrap a Twitter clone. As far as I know, Threads is the most successful of the non-Chinese market Twitter-esque microblogging services that are not Twitter. It seems to be doing well. They will presumably monetize it similarly to the way Twitter monetizes itself at some point. And that, again, it's going to be a whole lot easier for them to tell an advertiser, you're spending X million dollars a year on Facebook and Instagram ads. Why don't you put 5% of that into Threads, and you'll get some extra traffic, get some extra attention, and the Threads ads are going to be cheaper because people aren't advertising as much on Threads. So they would actually be, I think, quite hard to split up. And I also think that part of their view is that there should be their oldest thesis was there should be a canonical representation of who you are as a person that exists online. You should be able to interact with people online as yourself. And there shouldn't really be a gap between your digital self and your in-person self. And I think that was actually a surprisingly accurate view of the world. That was not a view of the world that people really held broadly in the early 2000s. I think for a lot of people in the early 2000s, you had your real life, and then you might have had an online persona, or you might have messed around online, but your username was probably something goofy. Your friends had to know what your username was. They wouldn't be able to search for you by name and find you online. If you had, yourfullname.com, it looked like this weird ego thing. I think Andrew Sullivan has actually written about this, that when he registered andrewsullivan.com, his friends just thought it was like this ludicrous thing, that it's, it would be, I don't know, like getting a custom doormat with like your family crest and things, like just like a weird ego trip thing to do. And now it's perfectly normal. Like it's just, a standard kind of SEO recommendation that if you have yourname.com, you at least control one of the Google results for your name. And that's probably a good thing. So they were probably right about that. And that makes it really hard for them to spin anything off, because they're suddenly fragmenting your one real digital identity into several different identities. There's the WhatsApp you for conversation with friends. There's the Facebook you for conversation with extended family members and former classmates. And then there's like the Instagram you for cool pictures you took. So I think they'd be highly reluctant to spin anything off. I also think that the Reality Labs division would just not be valued very highly by public markets, and would not be able to invest as much in R&D as Facebook would like. So a lot of these companies, they have these quasi-independent divisions. Those divisions do have some independent economic value. The companies do make a lot more sense as consolidated entities, but I actually suspect that over a long period, it just wouldn't be that fatal for these companies to spin off some divisions, especially the non-core ones, and to just accept that, they're going to have some frictional costs. They're going to be cases where the best person to solve a problem at Waymo was at Google, and when Google and Waymo were both under the Alphabet umbrella, that person could move over, and now that person has to get poached, and that's uncomfortable for everyone. But it's probably the case that these would be very valuable businesses on their own. And I don't know, it would make the market a little bit less fun to track, because I think one of the great joys of analyzing tech companies is trying to figure out what are their strategic imperatives, what are the things that they're doing that are like a 10-year investment in some grand plan that they're not going to talk about until it's inevitable, etc. But I still think that they'd be okay. Like the Alphabet companies and the Microsoft companies and the Meta companies would have a pretty solid track record if they were all split up. It just wouldn't be quite as good as it will be if they stay together.
Hey everybody, Eric here with a word from our sponsors. Fast forward to the end of 2024. Think about your goals. What can you do right now to give yourself the best chance of succeeding? If learning a new language is on your list, you absolutely need to check out Babbel. Babbel offers a range of learning tools, self-study app lessons, live classes, and even podcasts, which have always been my favorite way to learn. Studies from Yale, Michigan State University, and others continue to prove Babbel is better. One study found that using Babbel for 15 hours is equivalent to a full semester at college. Babbel isn't just a game to kill time and make you feel like you're learning a language. It's not overly academic or rigid either. It's all about learning language for the real world. Babbel stands out because it's designed by real people using a modern conversational teaching approach. It's not always easy, nothing worth doing ever is, but it's straightforward and designed to help you start speaking in just 3 weeks. With Babbel, I was able to brush up on my intermediate Spanish to ramp up for travel to Argentina last year, and was able to set clear goals based on how much time each week I wanted to practice. Join millions of Babbel language learners across all age groups. Here's a special limited time offer for our listeners. Right now, get up to 60% off your Babbel subscription, but only for our listeners, at babbel.com/zen. Get up to 60% off at babbel.com/zen, spelled BABBEL.com/zen. Rules and restrictions may apply. The tech world turns to the Brave browser for its unbeatable privacy protections. But did you know that Brave also has a private ad platform? Brave Ads offers first-party targeting, and it's been cookieless since day one, so you can relax while third-party tracking cookies disappear from the web. Today, millions of people turn to ad blockers to avoid being tracked and pestered online. But Brave's new ad model aligns incentives for users and advertisers. Users earn rewards for viewing ads, which they can save, spend, or pass along to their favorite creators. And advertisers score points for respecting user privacy, generating ROI without invasive tracking. So whether it's high-impact announcements on the new tab page or keyword-targeted ads in Brave Search offers diverse, private, future-proof ad formats for all your business goals. Join the future of advertising at brave.com/ads. Mention Turpentine to get 25% off your first campaign.
I want to transition to Currencies. You wrote about sort of the compelling reasons why countries want to have their own currencies and why companies try to do that too.
Yeah, yeah. So I think currencies are just a really fun, concept because there is this sort of instinctive view of you don't strictly need them. You could barter. We don't really have a lot of examples of ancient societies actually having barter economies. It seems like money is like a primitive, unless you have a society where there just isn't anything to buy. And even then, people find something to do. They find some way to do gift exchanges and ritualized loans and things like that. So money is a weird product because it has really powerful network effects. Like everyone implicitly if they don't denominate their money in if they don't denominate their wealth and their spending in whatever the local currency is, they're very likely to use the dollar unless they are adjacent to the Eurozone, in which case they might use the euro. And, maybe you have a handful of places in East Asia where people think in terms of local currency or in terms of yen, and yen is kind of the more store of value, stable sort of asset. But yeah, for a lot of the world, the dollar is just this universal denominator. And yet, the network effects, like all network effects, like they're self-perpetuating. The more people who are using dollars, the more it makes sense to have dollars, and the more it makes sense to denominate contracts in dollars. Like a huge fraction of international trade that is between countries that don't use the dollar, don't use major currencies, is just denominated in dollars because they know that whatever they need to buy, they can probably spend dollars to get it. So if you think that through from first principles, you would think, okay, once you have pretty much instantaneous global communications, once you have pretty good data, and as long as there's nobody who's under US sanctions, you'd expect everyone to just use the dollar. Like, why would we have any other currency other than the single best currency? And then there's a pretty good answer for countries, which is they also want to have their own monetary policy. The interest rates that you pay on dollar denominated debts are set based on economic activity in the US, whether that's markets setting rates, longer term rates, or that's central banks setting shorter term rates. And you just don't want to be in a situation where your country goes through some kind of economic crisis because the US is managing its interest rates based on its own interests. And so, yeah, a lot of countries issue their own local currency. They have more control over it. That allows them to manage their own economy a little bit better. But then you also have the weird case of companies issuing either currency or currency-like units. And there are a couple examples of this, one of which is in casual gaming. You almost never have a case where you are spending $1 on a power-up. You almost always have a case where you're spending gems, or it's usually gems, but you're spending gems, you're spending magic coins, you're buying potions, etc., and then spending those. They try to set things up so that you are always spending an intangible digital good. And when you do spend dollars, it's to buy the ability to buy a bunch of these intangible digital goods. And they have a couple of reasons for that. Like one way to model a company like Clash of Clans is that they're sort of an artificial way to create one of those kind of scammy foreign exchange offices that you'll see in airports or at Times Square or something, where it's just a giant ripoff in terms of exchange rate, but you do get to translate your money into something you can actually spend wherever you happen to be. And they have weird pricing for these, and they do lots of discounts and flash sales and special offers and things, because they are part of what they're taking advantage of is that there's this weird dynamic if you are spending money that you don't think of as money, where you can sort of hedonically double dip. And I think this also shows up, and we'll get to this in more detail with loyalty points, but with an in-game currency, when you are playing Clash of Clans or whatever the popular games are right now, you spend your $10, and when you spend it, you feel like you actually did just do a currency exchange. Like you had $10 of US dollars, now you have $10 worth of gems, so you haven't really lost anything. But then when you're spending your gems in the game, you might also think of that as these were just like digital goods. These were not real things. I'm not actually losing anything when I buy a power up. I'm just making a number on the screen change and getting an experience in the game that I want. So you get some level of kind of both times you don't quite feel like you're spending money, but in the end, your money has been spent and revenue has accrued to your counterparty. Roblox has a really interesting setup there where they want there to be this lively in-game economy. They want Robux to be just circulating throughout the economy. And then you do end up paying essentially an excise tax when you spend money within the Roblox ecosystem, but they actually adjust that tax rate based on what it is that you're doing. And what they've recently done, which I thought was really interesting, is they've been trying to get more high-end game experiences in the Roblox ecosystem. And that makes a lot of sense because anytime you have a game where it's really popular with a certain age group, that age group is going to age out unless your game ages up with them. And so for Roblox, it's like every time someone turns 13 and switches to playing AAA, action titles or real-time strategy games, like that's a problem for them. But if they can make Roblox appealing to the 13 and 14-year-olds and they can keep on extending the age at which Roblox makes sense, then they basically end up just demographically building the metaverse. It takes them a generation or so, but it does eventually happen. So they put a lot of value on these more engaging and higher production value experiences. And they literally put a higher dollar value on that in the sense that creators who are building things that people play on desktop and are building these high-end experiences actually get a larger cut, especially if the customer is directly spending dollars. So they are actually trying to go after, I guess Fortnite would be like the main thing that Roblox, or would be one of the things that Roblox implicitly competes with, where if you're in grade school, maybe you hang out with your friends in Roblox, and at some point in middle school or high school, you switch to hanging out with them in Fortnite. If you can sort of Fortniteify the experience that the older players in Roblox have, you keep them around a little bit longer, and then you get to monetize them a little bit longer. So that's the digital currency or the digital in-game currency side of things. And then there's the loyalty point side of things, which I think this is like an amazing case of the hedonic double dip, where if you are buying a plane ticket and you get miles, you feel like some of this flight was free. Like you actually got this sometimes pretty substantial discount on your spending. And then when you spend the miles, you also feel like, hey, I got a flight for free. So essentially, if you are getting back whatever, 5 or 10% of your spend, you feel like you're getting back 20%. If it's 10% of your spend, you feel like you're getting back 20% because it felt like you got a 10% discount at the point of purchase. And then it felt like you got a free flight at the point that you redeemed your points. And they could just denominate those in dollars. They could just say, you have a United savings account and we're going to sweep some of your spending into that savings account, and then you can spend that money on tickets later. But if they denominate it in miles, they have a couple of advantages. One of which is people don't necessarily rigorously evaluate those miles and figure out exactly what a point is worth and whether or not they should spend it. And also, it means they can devalue them. Instead of saying your account balance has been cut by 15% because we felt like it, they can just say, hey, we're changing the structure of our rewards program, and here's the new structure. And then people might do the math and find that for some of them, it's worse. For some of them, it's better. For some of them, it's just kind of a headache to do the math. And they will just periodically notice that they can spend their points on something and then spend them. But it does give them basically another lever to pull for slightly affecting consumer behavior, both in terms of how they spend their cash, and also it gives people a reason to opt into one provider for these services. So if you're flying a whole lot, you probably do want to choose a favorite airline because they try to set up the structure so that you get these non-linear rewards for earning lots of points from just one airline. And that also means the airlines, and especially the hotels, get these weird complementarities where like the more business travel revenue you have as either an airline or a hotel, the more valuable it is, like the better return you get on really high-end leisure travel. So like if you have pretty nice hotels that are either near the airport or near downtown in all the major cities that people travel to for business, then your return on also having a really nice resort in Hawaii or something is actually a lot higher than it otherwise would be, because people are getting points for travel that their employer pays for, and then they're redeeming the points for travel that they want to enjoy. So yeah, it's a really nice system for the airlines. It is kind of surprising that large companies are as tolerant of this as they are. Like most of the time, if you found out that your employees were getting kickbacks when they spent company money on something, you would be pretty annoyed. But I think this has just been established as a sort of socially acceptable or maybe even socially desirable form of kickback, where the airlines and hotel companies will handle the details of periodically giving someone an employer subsidized vacation.
Wasn't this the premise of crypto, that people would be able to create their own currencies easier? And on an individual level, we'd all have sort of social tokens, and the proliferation of currencies that would enable some of what you're talking about?
Yeah, that's true. Like you could, and now that there are nice, convenient front ends for creating meme coins, you could create a token about yourself. You could also create a token about me if you wanted. But when fiat currencies, and like It's crypto, but it's implicitly fiat to say this currency has value because I say it's associated with this concept, whether that concept is a pure meme or, a particular dog or a dog wearing a particular hat, or if that currency is associated with you, like you're giving it value based on either your endorsement or, and this was Joe Weisenthal used to do this thing where he created a fork, or he had a friend create a fork of, I think, Litecoin that was called Stalwart Bucks. And I think the shtick was like he had a dinner and you had to pay Stalwart Bucks to go to the dinner. But the reason, like, that actually works reasonably well, or could work reasonably well, because it actually replicates the economics of fiat currency, where the fundamental reason that you have to value dollars is that the US government will ask you for dollars on April 15th. And if you don't have dollars, problems ensue. So they are essentially doing a buyback to pump up the price of their token. They're doing a buy and burn. And that allows them to issue more tokens because those tokens will retain their value because they're constantly being repurchased and destroyed. So you could create such a currency for yourself, but then you have to figure out, okay, what am I charging people for that allows this currency to maintain its value? And if so, why? Like, if I had something I could charge people for, why would I have them exchange their money for some other form of money instead of just spending US dollars on me? So we go back to the network effects question of, if you have these alternative currencies, they probably have a pretty wide bid-ask spread. They're probably not going to be market makers who make a market in 8 billion different personal tokens. And if those market makers did that, they would probably be constantly getting ripped off. Like, people would absolutely delight in manipulating the price of their tokens. And so eventually it'd just be very hard to find anyone who'd want to trade them with you. And with the US dollar, like, you can't really manipulate the price of the US dollar. You could definitely try. And it would be interesting to speculate on who in the world actually has who is not part of the Fed, part of the US government, has the greatest capacity to change the value of the US dollar on their own, and what would they do, and what would their motivation be to do that. But realistically, there's just no one out there who actually has the capacity to devalue or substantially revalue the US dollar for any sustained period of time. It's a really big, really liquid market. There are a lot of people with dollar denominated debts. And that is the other thing that keeps fiat currency sustainable, is that a debt denominated in a fiat currency is also a short position. If you have a short position, you have to buy it back at some point, or you have to find someone who's willing to roll over your loan. And because of that, there is just continuous demand for people to source dollars in order to service dollar denominated loans. This is also why the British pound lasted as a reserve currency for a lot longer than the UK was a dominant economy. So US probably surpassed the UK in late 19th century in terms of total economic output, but the dollar and pound sort of traded places for a while as the most important international currencies starting in the 20s and 30s. And then the dollar didn't really become the main dominant currency until like late 40s, early 50s. And it has been since then. And the reason that people still wanted British pounds in, say, 1925, when the US economy is a lot bigger than the British economy and growing faster and more globally important, the reason they wanted pounds was they had borrowed pounds. They borrowed pounds 20 years before to build their railroads and their mines and their ports and things. So they still needed pounds in order to pay those debts. So if you find someone who is willing to borrow money denominated in your personal token, you have found someone with a very weird risk profile. And I'm not sure that person will have a lot of purchasing power over their entire lifetime, and they will probably not have a big impact on long-term asset prices.
Yeah. Segueing to a different kind of sort of risk profile analysis, you wrote about why it may not be as optimal to have a concentrated strategy as people think. And then there's not obvious or subtle benefits of diversification or an optimal level of diversification. Why don't you talk about that?
Yeah, so this was a piece, I actually was linking to this. It's a piece by Owen Lamont, who was writing about how Warren Buffett has a lot of really snappy lines about diversification, and how you're basically betting on your own ignorance when you diversify, and you should find a handful of ideas that you really you are really high conviction on, and you should just bet massively on those. And Buffett has done that, and he's done very well with that historically. And his portfolio is still a lot more concentrated than what a lot of investors would expect and would want. On the other hand, it is also just mathematically true that when you add diversification, like the smaller your edge is, the more diversification benefits you. So for the average person, you should be pretty broadly diversified. And in fact, Buffett does say like the average person should just put their money in an index fund and never think about it again. So he does advocate a lot of diversification for people who are not trying to actively outperform the market. And he is right that, yeah, the more concentrated your portfolio is, the more likely it is that your performance will deviate meaningfully from what the market does. What this is actually one of the nice contributions of academic finance is putting a little bit of rigor around this concept that when asset prices bounce around, it does actually hurt your returns. And all else being equal, if you have two portfolios with similar returns and one is more volatile than the other, you actually want the less volatile one. And one of the things they say, which is a pretty easy intuition on this, is if you just want more volatility, but you have an excess return, you can use leverage to get whatever volatility you want. And that actually cuts in both directions. If you have something that has really good risk-adjusted returns, like let's say it's some crazy NFT trading strategy or something where the returns are really good, but also there's insane volatility, you can just do that strategy with 2% of your bankroll. And let's say you get S&P-like returns, and since you're only doing 2% of your bankroll, you get less than the S&P's volatility. That's a good situation. And so it like that kind of thinking on diversification, it makes a lot of sense if you have control over how much leverage you have. But also, Buffett's thinking on concentration does implicitly assume that you know what you're doing and you're really good at it. And it also kind of assumes that you're using this sort of Buffett-like strategy. Like he does talk a lot about this idea of the margin of safety, of you invest in things where you know that they will be profitable over the ensuing decades, and you don't have to worry that, you know, people are going to stop drinking Coca-Cola or, you know, stop buying insurance or whatever. Although it does turn out that in some cases, like people do drink less Coca-Cola than they used to, or at least the growth is not what it once was. So those kinds of things are hard to underwrite. But if you're running a trading strategy like that, you do end up with a lot of companies where it's just not very plausible that they will stay super cheap for a very long time. If you're not very levered, you can survive the occasional 50 or 70% drawdown. It takes a lot of compounding to recover from a 70% drawdown. It takes a very long time. If you make 70% after you lost 70%, you are not back to even by any means. So that volatility drag is an actual cost for investors. And if you even slightly overestimate your skill, then that massive concentration strategy is a huge loser for you because you're losing all the benefits of diversification. Like the standard deviation of your returns is really high. And then the expected returns are also not that good. So at that point, you can have a case where you do have an edge, you overestimate the edge. Because you overestimate the edge, you overbet. Because you overbet, your actual realized return is worse than average, even though your ideas are better than average. And you can view like the entire modern hedge fund, like the entire modern multi-manager, tight risk management hedge fund complex as a way to just beat stock pickers over the head with the idea that you care about how your pick contributes to excess returns. You care about how those returns are, like whether those returns come from broad factors that are very easy to bet on, or whether they're company specific factors, and that you should get paid only if you had some specific insight about a specific company that paid off, even adjusting for everything you can adjust for that would also explain some of those returns. So these are like different schools of thought, but also the essay that talks about this, it does talk about how someone went back and they looked at Buffett's stock picks and then they back tested a strategy where it's actually less concentrated and they got better excess returns. So there is like this crazy hypothetical where if Buffett had been a portfolio manager at Citadel, had the same stock picks, like liked the same companies and had the same rank ordering of here are the stocks I like, here are the stocks I hate that I would short, that his risk adjusted returns would be a lot better and they would presumably be willing to lever that up a whole lot more. That said, like if you look at Buffett's early returns, he just did not need to spend a lot of time thinking about those kinds of risk-adjusted returns and things. There were just so many really cheap stocks, and he memorized all their balance sheets already. So he was able to really clean up in the 50s and 60s. Things have slowed down since then. And yeah, his track record is really hard to argue with. So I guess it does come down to this philosophical question. Like if you're spending all of your time thinking about asset mispricings, you want to spend some fraction of your time thinking about what is the optimal way to take advantage of those. And you really don't want to be in a situation where you are substantially poorer, and compounding means that you can be, you know, slight differences in returns can mean an order of magnitude difference in the final outcome. You don't want to be poorer because you had a good strategy and you were overbetting. It would be kind of tragic. Like you can take any good strategy and turn it into a bad strategy by betting too much of your bankroll. No matter how good you are at poker, if you always bet all of your chips, you will eventually get wiped out. Then someone who is less good at assessing the odds and less good at making these, you know, making the right directional bet will still end up making more money because they took less risk. So yeah, it gets complicated. Like some of it does come down to just how much attention do you have and how much time can you spend thinking about the next investment you make versus monitoring your existing investments versus figuring out the right risk adjustment framework. And we do seem to be moving, like asset management seems to be moving in this direction of actually separating out those concerns into, like, there are people who think about all of these at once, but there are a lot of people who are thinking about either conditional on having good stock pickers with good stock picks, how do we construct the optimal portfolio? And then other people thinking about, okay, of the 20 companies that I'm monitoring insanely closely all the time, which ones are doing a little bit better than expected, which ones are doing a little bit worse. And then I will tell that to my PM and we'll fit it into a risk mandate and construct the optimal portfolio. But yeah, even if I would personally want to put 25% of my money into one of these names, it's probably not going to be 25%. But in the end, the total dollars made from getting the risk adjustments right will exceed the total dollars made from just running a really concentrated portfolio and occasionally blowing up.
Speaking of portfolio, you also wrote about how pods, while a good idea, seem to just not be working in practice.
Well, there was a specific pod model, which I thought was a really clever model, and they were just not able to raise money and eventually shut it down. When I described this pod model where you have the analysts who are pitching ideas, the portfolio managers constructing a portfolio, and then there are risk people who are figuring out what are the parameters that we should set for how this portfolio is constructed. One of the questions this raises is, like, why do you have the portfolio manager at all? Like, it almost seems like this is a sort of clerical task where periodically some very smart analyst will email you and say, I like NVIDIA right now. And then you'll also have an email from a very smart risk person saying you can allocate no more than 4.7% of your portfolio to NVIDIA. So, why not skip a very expensive step and just have the risk managers figure out the optimal construction and the analysts pick stocks and we'll run it from there. And that didn't, like, it makes a lot of sense. It does imply that you should be able to run a similar model and charge lower fees, but investors were not incredibly excited about that. And I sort of wonder if part of what that illustrates is that they actually want there to be a person making the decision. They at least want there to be a specific person who is responsible for a given trade. And if you have this model where the stock pickers are only making these relative judgments about stocks, and then the risk people are only figuring out optimal portfolio construction, there's not actually a good answer to why were we long Google when the stock is clearly not working. Like, both sides can just say, I thought that was the other guy's job. So whereas the portfolio manager, I think one of the reasons they get paid a lot is that they do, like, there's no one else to really blame. The portfolio manager, like, they looked at the analyst's work and they decided whether or not to pull the trigger. They considered their risk mandate and operated within that. So they are the ones who actually have to make the call. And I think the other reason it was hard for this to work was that funds already do something called alpha capture, where they are constantly backtesting all of the portfolio managers they have, all of their ideas, and trying to categorize those ideas. Back in the day, this would be more of an impressionistic thing where you read a lot of pitches and try to figure out, okay, was this more of a momentum bet, or was this like a bet on shifting sentiment? Was this a pair trade or a standalone idea, etc.? Now, I would imagine that LLMs are hard at work just structuring everything and clustering all of these ideas into their unique categories. But what you figure out is, okay, this investor is really good, like, this portfolio manager is really good at detecting accounting frauds. So if he's short a stock, thinks it's a fraud, we in our main fund portfolio are going to short a whole lot more. This other investor is an egomaniac, and every time a particular company is reporting earnings, this person's going to have a massive bet on earnings, but those bets are no better than 50-50, shouldn't be doing it, but won't stop. So when that investor makes a bet on this company's earnings, we're just going to offset our fund's exposure to that bet. And you can run all kinds of analyses like this. And what you get is a set of signals that allow you to enhance the overall fund's performance. It makes the actual stock pickers really mad because the fund is actually competing with them and is basically taking their best ideas and trading on them in more size. It's probably particularly annoying on the short side if you are shorting something where the cost of borrowing it is expensive, because if someone else shorts a massive amount of it, then you're paying a higher borrow cost. On the other hand, it means that those funds can actually afford to pay portfolio managers a larger share of the profits they generate because the fund is also making profits from this analysis of them. So in a sense, that new model of we'll just have stock pickers and we'll construct a portfolio systematically around it, that already existed as just an add-on for the existing multi-manager product. And if you are taking two streams of returns that are not perfectly correlated, you can kind of stack them together, lever them up a little bit, and get something that is better than either of those on its own and charge higher fees for it. So that is my best guess as to why this didn't work, is that the big hedge funds were able to say, yeah, like that's an interesting concept. In fact, it's so interesting that we've been doing it for the last 15 years.
Yeah, that is funny. Well, on that, we're just about at time. As always, this was a great discussion, and until next week.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.